With a 7.8 print on a recent PPI, has inflation gone from hot to scorching? David Hunter, Contrarian Investor, is my guest on GoldCore TV this week, and he thinks that inflation is going to start to fuel a melt-up scenario in stocks and could see the Dow Jones hit 40,000, the NASDAQ 18,000, and 5,000 on the S&P. Where does this leave gold and silver? Where does this leave the dollar? For all this and more, watch this episode of GoldCore TV. And remember, if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, visit goldcore.com, your precious metals specialists. David Hunter, welcome to GoldCore TV.
Yeah, thanks, Dave. Thanks for having me.
Now, you call yourself a contrarian investor. What have the markets or what have commentators got wrong at the moment?
Yeah, I think right now what you see, particularly in the U.S. markets, is a sense that the market may have topped out and that the economy's probably seen its momentum peak and is rolling over, but at the same time, they're worried about inflation and therefore think the Fed's going to tighten sooner rather than later, or certainly taper much sooner than people anticipated. And I tend to disagree with most of that. I do think we're going to see the economy reaccelerate into the end of the year, and inflation probably accelerate as the economy does. But I don't think Powell's ready to taper yet. I think he's still looking at, more than 10 million people out of work, and he's been pretty clear about saying we want to err on the side of going too far. I think he got burnt back in 2018 by raising rates and thinking he needed to get ahead of the curve, and then obviously things got pretty rocky there at the end of the year. So I think he's this time around a little more willing to go further, and they've certainly expressed that in all their commentary that they want to err on letting inflation run hot. So I do think that's going to happen. I do think ultimately the Fed is going to have to tighten, and they may even move right through taper to tighten faster than people think, meaning pulling money out of the system, not just reducing the amount of money they're putting in. But I don't think that's in the next 2 or 3 months. I think the next 2 or 3 months, we're going to have the wind at our back in terms of the stock market, coming back as the economy accelerates and, inflation doesn't get out of control yet.
Now we got, you talk about inflation not being too hot, but we had producer prices figures out last Thursday, 7.8% year on year. That's the highest on record. We got CPI in the mid 5%, looking like it's going to continue northward. Are we beyond the hot inflation and kind of into scorching inflation at the moment? And, is there a risk that the Fed are going to be behind the curve when they start to raise rates? Or is it a case that they're painted themselves into a corner, and even with inflation at this height, they can't because they're pandering to the stock market? I mean, what is it?
Right. Yeah, I have all this year, probably started sometime last year, talked about we would have an inflation problem, and it would ultimately be what caused my view for 2022 is we're going to see a global bust and a potentially 80% bear market. So I've been of the belief that inflation is going to get to a point where the Fed's going to have to tighten way sooner than people are anticipating, and that it will lead to, because of the fragility in the global system, it will lead to a much faster, much steeper unwind than anybody expects. So I am in that camp that inflation's moving in that direction. I'm just saying here in this, this summer's, and particularly the number today, I don't think that's going to stand in the way of a market rally here. I think as we move through the year, and I don't know whether that means, October when you get September's numbers, or, November when you get October's number, but somewhere in there, I think inflation is going to be even more of a problem. And it may not even be CPI, PPI, because those numbers are already reflecting a lot that happened in the last year, it may be more commodity prices, futures, things like that could heat up here in the next several months. So I do think inflation is a problem, is going to be a problem for the Fed. I just don't think it stops what I think is a final melt-up move in the stock market.
So when do you actually see that melt-up move? You see that coming ahead of the Fed effectively taking away the punch bowl?
Yeah, I think it's imminent. I think it starts right here and moves probably into, through September, maybe into October. But I think it's the next 2 or 3 months at the, probably the longest. And I'm calling for 5,000 on the S&P, 18,000 on the NASDAQ, 40,000 on the Dow. So it's going to be, if I'm right, that's going to be a very sharp move from here in a very short time. It's what I call the end stage, the parabolic end stage of what I think is a 39-year secular bull market that started back in August of 1982, which coincided with the beginning of the whole disinflationary movement. So we've had disinflation from 82 until now. I think 2022 may be a deflationary period. So we've broken out on inflation. I think it's going to lead to Fed tightening. And that tightening, because of the fragility and leverage in the system, is going to lead to a very sharp downturn that temporarily might even tip into deflation. And I describe a bust. I talk about a global bust. I describe a bust as something worse than a recession, but shorter than a depression. So it'll feel like a depression, but I think it's pretty much contained in 2022.
So we're looking at 5,000 in the S&P, 18,000 on the NASDAQ, and 40,000 on the Dow. Now, given that fundamentally most stocks don't actually warrant that valuation, you're suggesting then that this is mostly driven as an inflation play?
Yeah, I think it is. I think you're going to still, and this is a little controversial, but I think you're still going to have leadership from tech right into the top. Typically in a cycle, the leadership that got you there stays right into the end. So maybe it won't go all the way, but pretty close to the end. I think you're going to see the FANGs continue to do well. And they had a consolidation, obviously, for the first several months of this year. I think you're going to see them break out of that consolidation. And so Apple and Amazon and all of those, Facebook, should participate in this melt up pretty well. I think semis still have life. I know today people are, there's some calls out there turning negative on semis. I think semis have a lot of life left in this last melt up. But I also think it's going to be a broad enough rally where you're going to have both the kind of the growth area and the, economically sensitive stocks. So I think you will see industrials and basic materials continue to play. Probably some of the consumer discretionary stuff. I think, utilities obviously struggle if rates move up here. And I did make a call when the 10-year was at 175, saying we'd go to 120, and then from 120 go to 2.5. I think we're beginning that move to 2.5, but it won't be a straight line. You could go back to 125 before you move up to 150, that kind of thing. So it'll be back and forth, I think, for the next month. But ultimately, as inflation rears its ugly head even more, and the Fed gets more pressure to say, hey, we can't view this as transitory anymore. I think as we move through the balance of this year, at some point, both the market's going to push rates up and the Fed's probably going to have to start talking tougher about tightening. So, I think that's what we have in store for the last, 4.5 months of the year.
Okay, so we got inflation starting to get out of control at this moment in time. The Fed being painted into a corner and having to act. Prior to that happening, we get a melt up in stocks. Once the punch bowl is actually taken away, we're going to see a massive correction. Now, obviously, with the increase in rates, we're going to be seeing higher bond yields in that scenario. That doesn't bode very well for the US, given the state of the debt at this moment in time, having to roll over debt at higher rates, particularly with the continuation of money printing and for the stimulus packages. what happens to the dollar in that situation?
Yeah, I'm of the belief that the dollar has just gone through several months of a counter trend move here, and that what comes out of this, and it may not make sense because I'm talking about rates moving up, but I think the dollar from here is headed for the DXY index is headed for 85 and maybe 80, and I think we could be there by the end of this year, early next. So it's going to be a pretty sharp move down from here. It kind of is the extension of the move down from 104 to 89. We've spent the last several months going 89 back to 93. I think that was just a counter trend move, and I think we exit from this counter trend in a very sharp downward direction. And by the way, because I am looking for rates to move up, the 10-year to 2.5 and the 30-year to 3, people will say, well, that can't be good for the miners. But inflation is probably going to be outpacing that move. So real rates are actually going to be moving down while you get that kind of a nominal move in rates. So I'm extremely bullish the miners here.
Yeah, I mean, there's no way that the Fed are actually going to be able to. They're going to be so far behind the curve that you're going to see real rates are just exploding at this stage.
Yeah, well, yeah. I mean, real rates are very negative now, and if inflation's going to move up from here faster than rates move up, at least for the next few months, your real rate's not your problem. I mean, real rates are going to be very negative. So I think we're putting in a bottom here. I didn't expect this last shakeout in gold and silver, but I think it's really a final move down before we move up. My target on gold for this year is 2,500. For silver is 45 to 50. May not happen by the end of the year, might get pushed into the first quarter, but I think there's a pretty good chance that we might see the whole move before the end of the year.
Well, the situation where we've got high inflation and increasing even faster and further, and you're suggesting a weakening in the dollar, this is obviously playing very much into the hands of precious metals owners and traders, and potential for a move to the upside. Now, I know that it's a while back when you put that, you said gold and silver were poised for that breakout move to 2,500 in gold and $50 on the silver. Since then, only the beginning of last week, we had that flash crash, as it's termed, where we had massive selling, very large volume, over $4 billion worth of selling in Asia now, is at the open of the Asian market in highly illiquid time. It's still not clear exactly what happened. I'm not too sure whether we'll actually ever get an answer to that question either. But it's unlikely, unless somebody has forced into a massive margin call, that was a fund dumping a large amount of gold onto the market at that time. It just doesn't make sense in an illiquid market. Unlikely to be a fat-fingered trade. What's your sense of what happened in that flash crash?
Yeah, I think certainly it started in the U.S. on Friday with the jobs numbers. And that's part of when you asked me at the outset of this about a contrarian view. I think that narrative out there and last Friday, the Friday jobs payroll number, non-farm jobs payroll, really set it off in this idea that, oh my God, it's all about, everybody's fearful that we're near the end of this game and the Fed's going to have to tighten. And that just fed into that. And I think, unfortunately, the algorithms have a lot of clout these days. They just kind of move quick when they see something. And then I think it spilled over into Asia on Sunday night our time. And I do think it was just a case of a very thin market and people kind of reacting to what they couldn't react to on Friday. And there may be some games being played, people trying to, push the stops, et cetera, and get better prices. But I am of the belief that this is more a bottom type activity than the beginning of some big decline, that that we're rolling over. And of course, there are an awful lot of people out there because gold's been in a year-long consolidation after the nice run last summer. That there are a lot of people have given up on it, and this was just kind of the final throw in the towel type moment. And what we're getting today is more of that retest of the lows that we saw in that flash crash. So at this point, I may be proven wrong, but at this point, I see this as more bottoming activity than anything else.
So we're putting in a low at this stage and offers people potentially opportunity to get long. They say buy when the sentiment is low, and I think sentiment for gold and silver, precious metals in general, hasn't been lower than it is now over the last year or so.
Yeah, and probably longer than that. I mean, we really are at the levels that you saw, in some of these other periods. Back in 2015, I think gold was 1050 at the bottom. 2018, it kind of retested 1160. People forget where we've come from. You would think with the kind of hate of the metals, you would think that these things have never moved before. I mean, gold came from 250 to 1900. So it had much longer consolidation than you normally see. But, it's come from 1050 in 2015 to where it got to 2100. I just think investors are so conditioned to be traders, and when something like metals don't behave the way they thought, they lose money, they just become disgusted with them. So I think there's a real hate quotient around the metals right now, and as a contrarian, that's something I like to look at.
I'll put you on the spot now, David. What's the biggest risk that you see at this moment in time?
Obviously, if the Fed were to respond much sooner, you could see the top in and things roll over. I mean, I think that's the biggest one. But I look at sentiment, and sentiment, like I said, so many people are waiting for that. As I've said, it's amazing we're, a year, 16 months into the move out of the March 2020 swoon. The S&P has doubled, the NASDAQ's more than doubled. The Dow's pretty much doubled. And yet we've got people with one foot out the door. That's not normal investor psychology behavior. Normally, after such a big move, you would see that the stock, the sentiment would be way up in the bullish category. And certainly it's more bullish than it's been. But on a lot of metrics, sentiment's pretty cautious. More people are worried about where's the top, when am I getting out? It's not that they're out now, but they got one foot out the door. And so I just think sentiment is really giving us one last runway here before the exit.
Now, before we wrap up, David, can you just tell our audience more about what it is that you do and where we can find you online or on social media?
Sure. Most of the time I'm on Twitter. You can find me. My handle is at Dave H. Contrarian. So I'm on there most days with commentary or short blurbs about my views, taking hits from the trolls that think I'm crazy with my calls. And I also write a quarterly investment letter that if people, it's by subscription, so there's a fee to it. If people are interested, they can direct message me on Twitter and I'll get right back to them with details.
Super. What I'll do is I'll put a link to your Twitter handle in the show notes below this video. But for now, David, thanks for joining us on GoldCore TV.
Yeah, thanks, Dave. You take care.
Thanks for watching. And if you enjoyed this video, you'll definitely enjoy these interviews with some of the leading voices in financial markets and trading. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit your notification bell now. And if you want to learn more about how you can buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.